Participants indicated that provided the economy remained near maximum employment, they would want to see further progress on inflation before making additional adjustments to the target range for the federal funds rate. We're going to talk about that and a couple other things today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic, where I take your questions and we can go over some things, investment, economy, and options related. The comment that I just provided was from the Federal Reserve that basically indicated that they're going to be holding rates steady. As we talked about in our last live stream, former Treasury Secretary Lawrence Summers had already indicated that he considers this to be a very dangerous time with respect to risks of a resurgence in inflation. Wanted to point something else out that was provided by the Federal Reserve. In this case, it was the New York Federal Reserve. I have it on the screen right now. I believe we have a link to this in the description. What you're looking at is a picture of household debt, which hit just over 18 trillion. So that is including both housing and non-housing related debt. Auto and credit card delinquency transition rates remain elevated. Total household debt increased by 93 billion to reach actually 18.04 trillion in the fourth quarter, according to the latest quarterly report on household debt and credit. Aggregate delinquency rates ticked up 0.1 percentage points from the previous quarter to 3.6% of outstanding debt in some stage of delinquency. And mortgage balances rose by 11 billion to stand at 12.6 trillion at the end of December. Transition into serious delinquency, that was going to be defined as 90 or more days past due, remained stable for mortgages, but edged up for auto loans, credit cards, HELOC balances. Auto loan balances saw an $11 billion increase to 1.66 trillion in the fourth quarter, while credit card balances increased by 45 billion from the previous quarter to reach 1.21 trillion at the end of December. It was interesting when I was looking at that data in the context of something that was brought up by Elon Musk, which all will know is the head of DOGE, the Department of Government Efficiency. That department has been identifying, or it believes it has identified, significant waste, fraud, and abuse that they are hoping they are going to be able to correct. And he made, I think, a very off-the-cuff comment about sending $5,000 checks back to taxpayers, net taxpayers, so that they could essentially share in the benefit. The bulk of it would go towards reducing the debt and deficit, but some of it would be returned to taxpayers. And when I first saw that, my immediate response to it was, well, that doesn't really make a whole lot of sense, because when you think about it, we borrow money, we misspend that money. If we identify the misspending and we instead remit some of the misspent money back to taxpayers, then effectively we have borrowed money to pay it back to taxpayers, which wouldn't really make much sense. And at a high level, it isn't. That doesn't seem like an efficient process. But I thought about that in the context of this debt picture. So 1.21 trillion, which is the revolving debt held by American households. Right now, the average rate of interest on that debt is 23.37%. Now, that's slightly less than the student debt totals, but the student debt totals have an effective average interest rate of about 6.5%. And the other interesting thing is that student loan interest is deductible from one's taxes. Credit card interest is not. So there is a little form. Now, I have no idea whether the folks in Washington are contemplating these issues or not, whether what I'm about to suggest is just a complete accident. But the interesting thing about this proposal, and I'm not saying this is going to actually happen, and I'm not even promoting it, but it's just something to think about when we contemplate the finances of both individuals and the government. If the government borrows money at a long-term rate right now, which is about 4.75%, and then it remits that back to American households who carry, on average, about $6,350 in revolving credit card debt, which is being paid at about 23.5% effective interest, and they use the proceeds to pay down their credit card, then effectively taxpayers have borrowed money at 4.75% because it's government guaranteed to pay down their debts at 23.5%. And that obviously is a very good trade. Now, as we think about that, and we can decide whether that's an appropriate way for the government to get involved, but the government does, of course, guarantee some debt for Americans. It does so on the housing side when you're dealing with Freddie and Fannie mortgages. So, in any case, it's just an interesting talking point, I thought, things for us to think about. Something else for us to think about as we contemplate the government's spending is that the aggregate of the United States war spending, appropriations, and obligations associated with the war on terror and everything that we've done since September 11th has added up to approximately $8 trillion. Now, this website that I'm showing you here, this is from Brown University. So this is from their Watson Institute. So this is not, we can decide whether it's a partisan organization or not, but let's assume that their work is reasonably good. There's about 107 million taxpayers in the United States, so that works out to about $75,000 per taxpayer just spent on war and the associated expenses, in addition to the loss of about 900,000 lives. So I only bring this up because, there's a lot going on right now with respect to the Trump administration's efforts to try to put an end to the war between Russia and Ukraine, and hopefully some others too. And I just wanted this to serve as a reminder. If we think about the benefits that we have gotten from all of this, benefits, put that in quotes, I suppose, because I'm not sure that the United States has become materially more secure as a result of all of these wars. I'm not sure that we've improved our standing as a result of all of these wars. I'm not sure that we've improved the lives of people abroad, particularly in those geographical locations where these conflicts took place as a result of all of these wars. And I'm pretty sure we didn't improve our finances with all of these wars. And it just served to me as a reminder that, our biggest mistake where wars are concerned continuously seem to be not the last one, but the next one. We just always seem to be getting into another one. My hope is we can somehow bring that vicious cycle to an end. We can't afford it. I'm not sure that the world can. I am not sure that we have improved our circumstances much with all of them. So, with all of that, I see that there's some questions already here. One final point that I would like to just add with respect to the consumer debt picture. Remind yourselves that ours is an economy that is 70% consumer driven. And the rise, albeit small, but the rise in consumer debt, the rise in consumer delinquencies in revolving debt and auto loans, those types of things speak to the fact that the American consumer is not particularly healthy right now. Now, one of the things that I was taking a look at recently, in fact, yesterday I was looking at this, was the increase in the consumer price index. So rather than thinking about inflation as a rate that we're looking at on an annualized basis, the consumer price index just essentially is one way to think about what the net impact of rate increases has been, let's do this, over time. So, how much more a basket of goods might cost. Here you can see that if we're just going to use 1983, that's going to be around 100. But you can sort of see how the rate of change in prices might affect U.S. consumers. Now, by itself, And, I would urge you to sort of think about this in terms a little bit of various regimes. So, for example, let's just say that we wanted to say, okay, well, what happened in inflation in the Nixon era? And the Nixon era is important for one principal reason, which is that whatever was done, we essentially, whatever remnants of the gold standard, because FDR had allowed that to float, but whatever remnants of the gold standard remained were eliminated under Nixon. And you can see that the rate of change in prices during that's the slope of that line. I'll blow this up a little bit so we can get a better look at it. So we can just see the rate of change in the price index, which is going to be, granted by the slope here. That's what it looked like during the Nixon times. And if we went back all the way to, say, 1950, it was basically that kind of a slope. Now, what's interesting is that with exceptions, like during the Carter administration and here, in general, the rate of increase has been fairly steady, right? So I'll go right to the end of the first of Trump 1.0, we'll call it that. We'll just bump the size of this line up as well. So we can see that the slope of this line, it went higher and sometimes. Now, one of the important things, this is when Volcker got involved, early stages of the Reagan administration, jacked up rates, and then we can see actually that the pace of inflation fell quite sharply. Another time that the pace of inflation, as you can see, is probably a little bit less is during the Clinton administration. We ended up with a balanced budget at the end of the Clinton administration. So some of you may remember that that was maybe the earliest example of DOGE, if we'll call it that, Department of Government Efficiency, in my adult life was when Clinton and Gore, and it was actually Gore who was sort of the czar of money saving that Clinton appointed, worked, and not always in close collaboration, it should be said, with the Congress, and ended up with a balanced budget. So the Congress at that time was being led by Newt Gingrich, who was the Speaker of the House, and Dick Armey. They had their contract with America, but the net effect was that we balanced the budget, and as you would expect, inflation fell. And one of the other important points is that we frequently have seen, and we've had Professor Mark Guthner on in the past, and we have talked about how inflation throughout history, even when we had a gold standard, typically would suddenly speed up during times of war. We saw that in the post-revolutionary war period. We saw it during the War of 1812. We saw it during the Civil War. We saw it during World War I, World War II. And World War II was and usually those bouts of inflation were followed by periods of deflation, where prices that had risen going through those events actually reverted to their pre-war levels. And that makes some sense because supply and demand gets severely disrupted during times of war as the cost of prosecuting the war creates demands for goods. You are lowering productivity because you're sending people off to fight instead of producing food or goods and services, that kind of thing. But with something like a gold standard, then the prices should revert back to their level. Once we got rid of that and ended up with a fiat currency, we ended up with a circumstance that looks a lot different. Now, if you then take a look at what the pace of inflation has been more recently, if you just take a look at the slope of the line, so this just gives you a sense. And it's interesting, one other thing I happened to do was that inflation was slightly higher during George Herbert Walker Bush's term. So we had a recession and slightly higher inflation. It begins to become clear that the American electorate doesn't like that. And so they feel unhappy when they feel like it is harder to make a decent living. Sure enough, we take a look. That's also what happened during the Carter years. And so we shouldn't be that surprised, I suppose, that they fail to win re-election. But there is one other thing that I'm not mentioning here that deserves mention, which is, what about wages? Because we got wage data last week as well. So the interesting thing here is that if you look at the average wages, so this is the Biden term here, average wages rose at about the pace of and slightly higher than that of prices. But yet most people, consumer confidence data, if we look at the consumer confidence numbers that have been coming out, that actually has not been that great. And I'm going to get to why that might be true. So let's see if this, I think this is the one I want to take a look at. Is this it? I might have to search around. I think this is the one. So one of the interesting things about why the consumer confidence information data might not be so spectacular is that there's a very important difference between the average hourly wages and the median and the mode. So in statistics, if you have a perfectly symmetrical distribution, these things are all going to be the same number. But what is the median? I'm sure most of you know this already, but the median is the dividing line where half of the sample is above that number and half of the sample is below. And if you take a look at the median wages, in fact, during the Biden term, the median wages grew less than prices did. So that means that in real terms, during the Biden administration, most people were worse off. And if you look on the left side, you will find that those people were much worse off. And that's because people at the lowest end of the income scale, their wages did not rise in such a pronounced fashion as some of those at the top. And that actually shouldn't surprise us much because as we look at some of the data, one of the things that really benefited people at the top, and this isn't wage data, I'm just talking about their overall sense of well-being, is that asset prices rose really sharply. So if you owned a home, if you owned stocks, if you had investments in Bitcoin or gold or other types of risk assets, you did spectacularly well. And in fact, your net worth increased much faster than the prices for the things that you go out and buy every day. But if you're at the lower end of the spectrum, the opposite happened. And I think that speaks very significantly to the unhappiness that a lot of Americans felt. All right, enough of that. We can move on to cheerier topics. But I just thought it was kind of interesting as I looked at those things, how we got to that spot. So Ranjana Gupta, welcome back. Hi, Mike. Would you sell a cash-secured put on Palantir now that it's dropped 10% today? If so, what expiry and strike? So, and forgive me, I have a little bit of a cold. The 10%, it's interesting because the 10% decline in Palantir, while that's a sharp drop, it's, from a valuation perspective, we still find ourselves in pretty heady waters. And actually, let me bring up unusual whales here, because I think this is one of the things that is going to be interesting. By the way, as I previously mentioned, if you guys are interested in unusual whales, one of the things that you can get if you follow the link we have, then you get a 20% discount. And so let me just put this in here. So this is the important thing. I think I showed this before. And remember, when you look at this, so you'll notice that you see a lot of red, a lot of insider sales. And the issue here is, now, when you're looking at these greens and the reds in this chart, it might look, and I mentioned this last week, it might look like you're getting an even offset, but that's not really what's happening. If you have insiders with options and they exercise those options, what happens when you exercise an option? If you exercise a call option, you buy the underlying stock at the strike price. So that's going to be reflected here. So you see these conversions and exercises, that's what's going on. So those are really if you think about it this way, those are pre-existing grants that are converted into stock. And why were they converted into stock? So they could sell the stock. So the insiders are still selling it. You know, I love what Palantir is doing. They are riding a secular, from an operational standpoint, they are riding a secular tailwind. I will tell you all, I don't know if all of you are familiar. Now, this is not a publicly traded company, so the company I'm about to talk about, which I think is one of the most interesting and exciting that is, providing services to the government right now, is a company that was founded by the guy who previously founded Oculus. Oculus, if you don't know, Oculus was the VR company that was sold to Facebook a number of years ago. The founder of that company was pushed out in, I want to say it was right around the time of the 2016 election, and it was actually related to that. So the founder was falsely accused of supporting a bunch of extremist groups. I think what had actually happened was, he had given a donation to some Trump supporting group. It was a nominal amount because he had sold Oculus to Facebook for $2 billion or $2.3 billion, something like that. And I think he had made $9,000 in political contributions. And that was not well received by the folks at his coworkers at Facebook and others in Silicon Valley who really didn't care for Trump very much, and therefore really went after anybody who supported him, including this guy. So he ended up getting forced out. And very shortly thereafter, he founded a defense company called Anduril. Now, Anduril, actually, the reason I mention Anduril is because one of the very slick things that Palantir was working on, so Palantir is really into big data analysis, essentially, helping entities, including the government, that might be interested in trying to, get a handle on AI. One of the cool things that Palantir has a contract for, and you can see if you look over here, the Department of Defense, obviously one of the, and it's not just the U.S. Department of Defense, but you can see there's a couple different divisions of it. You can see various government agencies that Palantir services in addition to their sort of regular corporate commercial customers. One of the things that they were working on that I thought was very slick was a system that was a software system that was intended to help work as an anti-drone weapon. So what Anduril has developed, among many other things, they've got submarines, all kinds of cool stuff. I suggest you check them out if you're interested. And the reason I mention this is because I saw recently the founder mentioning that he intends at some point, he didn't specify when, that he intends to take Anduril public. Anduril, by the way, is based in Southern California. The founder is from that area. I believe he's from Long Beach. Really interesting guy, actually. Started going to college, I think, when he was like 14. He was homeschooled and started in college when he was 14 and then ended up dropping out to start a VR company. But the thesis, and the reason that's important, is because Southern California is home to quite a few of the defense primes. And in fact, Professor Mark Guthner, who will hopefully be on this Friday, he was an engineer by training before he went back to graduate school and started specializing in finance. And he actually worked on anti-ballistic missile systems, I think, for Northrop Grumman. We'll ask him about that when we have him back. But the interesting thing that if you don't know about the defense primes is that basically the way they operate, they and or procurement people from the military come up with ideas for weapons, and then the defense contracting primes go out and they start building these things, and they're allowed to charge a little bit of a markup. So effectively, the development work, whether it works or doesn't, the R&D, all of that stuff is carried along by taxpayers. Now think about that. Almost nothing else gets purchased in this way, and it creates some very perverse incentives. And to illustrate this, what Anduril does is they come up with cool weapons like electromagnetic pulse anti-drone technology. They design, build, and make it work, and then they go to the Defense Department and say, "We have this cool weapon." Now, this is, I'm not trying to be a war hawk here. If anything, as I was previously pointing out, I would like to see us spend a lot less on this. But one of the ways to spend less is to get more with less. And so, they come with a fully developed product, present that to the Defense Department, and they can buy it or not. So essentially, it's on the company's risk instead of the taxpayers. And I have a feeling that if we do things properly in D.C., more procurement will work like that than the way it has done. And that's because of these perverse incentives. And so I bring this up for two reasons. One, when Anduril, depending on its valuation, of course, but if and when the IPO takes place, it's a company well worth looking at. Got the best and brightest working over there. It's pretty slick. The other thing is, it presents a risk to the defense primes, right? So the Lockheeds, GDs, Northrop, Boeing, everybody else. Boeing's got its own problems, but that's something else. It's just something worth thinking about as all of this happens. Okay, so Palantir, and that's where we got to all of this. The valuation here is just really, really tough right now. You are reaching out and sort of grabbing the falling knife, if you will. I mean, you can see now that even net of a 10% decline, 206, let's just call it 260 billion to keep the math easy. And, and let's round up the trailing 12 months to 3 billion, right? So that's going to be this thing, it is pricey, right? It's trading 87 times trailing revenues. Growing quickly, but I don't think that a 10% decline is enough to race out to buy it. Not a knock on what they're doing, not a knock on their growth rate. What it is a reflection that it can be very tempting to pick something up when it seems like you're getting at a discount. But you can see that just earlier this year, the stock was half its current price, just a little more, call it 40% discount to its current price. So therefore, I'm not sure that I would race out to do that just yet. Give it a few days and see whether things settle in a little bit before you do that. Okay, the other day you showed a strategy with a double diagonal. A double diagonal. So I'm assuming you're talking about a strangle swap. But front month was after earnings, back was months out. Was this a ball crush play? It was. There's two things. So those strategies are specifically for circumstances where I'm going to put NVIDIA in here simply because I know that NVIDIA is reporting on the 26th, so it hasn't reported yet. And I may have to excuse myself for just a second so I can blow my nose without you guys hearing it. Sorry, I know it's really unpleasant to have to listen to a guy who's... So here's the circumstances. We take a look at these results where what you're interested in paying attention to is... Oops, why is this Palantir? I was looking for NVIDIA. There we go. What we're interested in is two things. One, what is the implied move, and how does that compare to our expectations for the movement? So if the implied move is very big, maybe bigger than it usually is, and if our expectation is that it is going to fall within it, perhaps well within it, then we don't want to own that vol, right? Vol is pricing in something greater than we expect. Now, we could be right, we could be wrong. Here's a perfect example. You take a look at NVIDIA, and you can see that in the past 11 reported quarters, because there's 12 reported here. This includes the implied move for this upcoming report. You can see that on four occasions, the move exceeded that which was implied, in some cases quite considerably. But in the other 7 cases, it was well within the implied move. So as you look at it, if you're looking at let's just take a look at this right here. This was a big move. So if you look back 2 quarters, very big implied move. Go back 11 quarters, you can see this was a very big implied move. So you have elevated implied volatility, which is not enough to justify selling it. If you then also believe, though, that the move is not going to be greater than that and may indeed be much less, that's when you're looking to do one of these vol crush plays, because you're expecting vol to come in, you make money on the Vega, and you're expecting it to remain within, because usually when you do these things, your strike selection, if you're doing 20 delta, a 20 delta call and a 20 delta put are statistically about the average move that you would expect between now and whatever date that is. So you sell a 20 delta strangle for next week, or for a month from now, or for a year from now, the math is telling you that there's a 60% probability, first of all, that it's going to land within those strikes. But the second thing is that's the average move. The mean absolute deviation is going to correspond to those numbers. So that's a part of it. The much longer dated piece that I had was so that it captured not just this event, but also the subsequent one. Because the vol crush won't be as impactful there, because it is going to continue to bake in subsequent events, subsequent catalysts. Okay, so with that, if we could take, I'm going to come to your next question. I'm going to take a break for 60 seconds or so, just so you guys don't have to hear me snorting away quite as much, and I will be right back. Seconds. Appreciate your patience. And with that, I'll have a sip of coffee too. Okay. Hi, Mike. Your thoughts on this, please? And I'm assuming from AMAT. Long May 170 call, short May 200 call, and short the May 165 puts. Call spread risky in May in AMAT. Okay, let's have a peek, see what we think of this. So, quick point. So, just a couple things about this. If you are in a call spread risk reversal, you are net short options. You're short a put, you're short a call, and you're long one at the money option. I've previously said, you know, a lot of these types of strategies, we should kind of think of them in a little bit like being in a cash covered put or in a buy right. They have, you're basically, if you can think about the risk and reward, the profit zones and the loss zones, you're kind of squeezing the balloon a little bit. Just trying to find areas of profitability. And that's totally fine because, you know, you may, especially as you go further out in time, you may have, you know, fairly strong feelings about the underlying valuation. So let's just take a quick peek. And actually, when is their earnings? I should probably check that first. Let's see. So we're taking a look at the, well, yeah. May. That's this expiration right here. So that looks like that captures it. So yeah, this is so a couple interesting things I would like to point out about this. I don't mind call spread risk reversals going into events like earnings. What is interesting, of course, in this particular case is that because the implied volatility is quite high, that is going to raise the delta. So if you have an at-the-money option, that's going to be roughly 50 delta, unless it expires, you know, tomorrow or something like that. But assuming that it's, you know, 30 days or a year, if it's an at-the-money option or an at-the-forward, which is effectively at-the-money, longer dated, it's going to be 50 delta. What is interesting, of course, is that if you raise the implied, all else equal, if you raise the implied volatility, it's going to increase the delta of the two options that you are short. So that's just something to think about. And what it means is that it can dilute a little bit some of that convexity that an option structure might otherwise possess. Now, this can work for you or against you. That is going to get affected by a vol crush after earnings when that happens. And let's just take a look. This is one of those instances where it can be worth taking a look at the implied move and then the historical moves to decide whether or not you think that the degree that the vol is elevated. And you just saw that it is pretty elevated right now, capturing that event. And here we can see why. The moves, the last two earnings were much bigger than that which was implied by the options market at the time. Let's just take a look at something else here really quickly. Let's take a look at implied vol going back, and we'll probably see some. Let's go back. We'll go back 2 years. Why not? And I'm going to put in 1 month and 30 days. See how big these earnings related moves were. So 45, 50-ish vol looks like. These bumps over here are the more recent earnings events. And your May options right now are, we'll just see where those are priced. Looks like about 35 vol. Now, by the way, 35 vol for an option that expires in close to 3 months' time does not mean that the event variance is priced at that level, right? So now the next thing I'm interested in is what does the options market say it is leading up to that time. So not including that. And a few ticks lower, it looks like. I think the strategy's, how about this? I think the strategy's okay. I think it's okay. I'm not wildly ecstatic about it. And that's because this, 35, 36 vol for options that encapsulate an event is elevated, but it's not hugely elevated. To get a sense of that, take a look at how this thing has been behaving. So, 30 is the low in terms of realized vol over any 30-day period in the past 6 months. Let's take a look. So you are selling options that capture an event at that line. And the orange line tells you how volatility has actually behaved over the course of the last 2 years. And bear in mind that several of these spikes, but you here, those are almost certainly earnings-related events. So it's fine, it's okay, but it's not a sitter. Meaning it's not a teed up shot. Let's take a look at what the technicals have to say here, because a call spread risky is obviously a bullish bet. You do have a, 5 to 7% downside cushion. Yeah, technicals are pretty mixed bag. It looks like it's more bearish than bullish. So, I don't know. It's okay. I get it. And, in addition to this, it's often tempting to say, give yourself a downside buffer. The valuation doesn't seem that unreasonable. I will say that there have been instances when I was trying to make a longer-term bet on a rebound where I just went out and bought long-dated calls. I did that in Ford a number of years ago. Simply because, once a stock starts to regain its mojo, it can it can go pretty far. Okay. Yeah, and the 95-cent okay, see, you're in a 95-cent debit. Time is going to work on your side. Generally speaking, the way this happens is that those wing options are going to decay as quickly probably as your at the money is in the short term. So you're not going to pay much decay. The 95 cents, who cares? 95 cents on a $175 stock. I mean, you're looking at a little over 0.5% of the current stock price. Not a big price to pay. So that is totally fine. Excuse me, one more second. Okay, I am learning so much from your channel. Hedging to neutral only for trading volatility, or are there other applications for it? Well, we, on the vol side, we always tried to be close to delta neutral. You can be in a relatively delta neutral trade in the short term that is also a vol trade that also has a directional bias. A strangle swap is actually a pretty good example, right? So when you put on a strangle swap, so I buy a long dated call, sell a near dated one, buy a longer dated put, sell a near dated one. The way that usually plays out is that you have a little bit more, you could be bullish. Let's say you think the stock's going to move 6-7%, and you're 70% sure it's going to go higher, 30% chance it goes lower. You really don't think it's going to stay put. Pretty close to a delta neutral trade, but it has some delta in the sense that after the event takes place and the vol comes out of that front side, that's a delta neutral trade or a long strangle. These are bets where you could have no delta at the time, but you're expecting something big to happen. But they're still vol related, I guess. So I'm sure there's a circumstance. A delta neutral trade that is not vol related is a carry cost trade. This is a little inside baseball, but we could talk about it if you like. If you believed that rates were going to go sharply higher, like you would have the kind of event change in rates that you saw back in the Volcker years, that would massively increase the value of calls relative to puts, all else equal. And it would massively increase the price of synthetic stock to the underlying. And so you would want to reverse. Buy, call, sell, put, sell stock. So that is a row trade, not delta or vega. You are making a bet on the carry cost for the underlying asset. It's a rates bet. So that's an example of a delta neutral options trade that carries essentially no meaningful directional risk, so no delta, and no vega. So, yeah, there are examples of delta neutral trades, but it's not that common, I don't think, for self-directed retail to do them. But you could. Boxes. Boxes are a carry cost trade, so that's when you basically buy a synthetic at one strike and sell it at another. So you would, if you are looking to lend to the market, you essentially have the effective of a long combo or a long synthetic if you're using futures on a low strike and a short one at a high strike. So give you an example. Sorry, this is a little, maybe you guys are interested in this. I have no idea. But this is a common trade. Options traders do this kind of stuff a lot to balance out the premium on their sheets because it has big interest rate expense implications for the vol trader. So let me give you an example. You will see these things trade, by the way. You'll see them there. You'll see boxes and SPX trade all the time. I used to trade them. So whenever I got net long premium, I might sell boxes, and if I was short a lot of premium, I might buy them. More often than not, I was selling them. Has to do with the way banks sometimes charge their traders for capital use, even though you're not taking any risk. So you have to pony up premium, so you want to take that off your sheets. So what am I doing in this case? So let's say I wanted to sell a box in the SPX. What I would do is sell, and usually it would be a 500-point box, something like that. So maybe I'll just use like the 5750s. 5750, 2550 as my example. So what I would do is I would sell July, in this case, if we're going to use July, I would sell a July 5750 call and buy that corresponding put. And then I would buy the 6250 call and sell that corresponding put. That position doesn't have any delta. It's not taking any kind of delta bet. It is also not taking a vega bet because I'm long and short the same strike. Is either buying premium or selling premium. And this is cash settled, so it effectively trades like a swap. But what this really is kind of like a zero coupon bond. Yeah, so this was a really common thing for options traders to do to balance out premium and to borrow and lend in the market. It's risk-free. It's a very, very deep market. And the spreads, by the way, if you quote these things up, we typically would trade these things, 25 million, 50 million in premium at a time. That might sound like a lot, but it isn't really for a bank, to put on or take off that much premium. And they're very commonly traded. Or at least they certainly were when I was still making markets in this stuff. Okay. Okay. Doji Nate. Hey, did you see the steel trade? Saw it on the Unusual Whales, 10,000 contracts. I didn't happen to be looking at it. It is obviously in play. Opening April 43s. Let's see. Steel deal will have new. Yeah, so I mean, this is a. I thought the Trump administration agreed that Nippon was going to be able to make an investment, not an acquisition, if my memory serves. Remember that press conference with the Japanese prime minister because, the feds blocked the Nippon acquisition. And, they were talking about making massive investments, including an investment in U.S. Steel. So that was the 43s. Last was 190. Let's just see. How much did these actually go for? So, yeah, looks like 12,000 of them trading for about $1.60. And implied vol data looks like they were bought. Yeah, I mean, it's like I said, it's well known that this is the names in play. So, yeah, that could be Estee Lauder. Steve Garcia. Estee has taken a beating, and I'm considering starting position. My wife still likes their products and says it's a good company. 80% pullback from Jan 22. Is it going to pre-COVID lows? Interesting you should mention this because we did a pairs trade, Estee versus Elf, quite some time ago. Maybe a third of a year ago, maybe a little bit more. It actually is more than that because I remember that the trade expired in November of last year. So probably in August or September, we did a pair in Estee versus Elf. The thing with Estee, so, this is a company that's seeing, it's not usually on my radar to trade companies that on the long side where they're really suffering. And what I mean by that is, this is the top line is shrinking, which is never a good situation. Could it get down to those lows? Well, here's a way to think about it. You're looking at $14.5 billion in revenues, and then go back to where it was back then. COVID had got down to 14 before that. So, the top line revenues are about the same or even less than they were at some pre-COVID levels. And again, excuse me, sorry. Obviously needed some Sudafed or something. But, and here's the thing. A company that has the same revenues today that they had 5 years ago, all your other costs are higher. I can't think of a business where all of your input and operating costs have declined over 5 years. If your top line is going down, your bottom line is going down faster. Almost certainly. So that is the challenge. However, I like what you're doing. It's a very Peter Lynch approach, and I do it. You know, I when it comes to consumer goods, Holly and the kids, they know a lot better than I do what's going on because I don't shop for stuff. You know, I don't buy my own clothes really. You know, they just sort of show up. They show up at Christmas and on birthdays or whatever. Somebody goes shopping, they say, "Oh, you know, here's a shirt for you" or something like that. Yeah, you get to a certain point in your life and these things just don't matter that much. And so it is. I can't remember the last time I went into a men's clothing store. It's probably been, you know, I had to buy a new blazer because I got caught in the rain, I think, when I was in New York, so I ran into Brooks Brothers or something like that. But, you know, if you want to know about consumer goods, talk to the people who buy them. So that part of the strategy I like. Estee, I'm not sure that they're completely out of the woods. Let's see what the technicals have to say. They're not overwhelmingly favorable either. You know, I think Carter has said this, and I've heard other people say it too. You know, I think you're sometimes better off missing the first 10% of a rally and realizing that it finally has started to bottom and reverse than just deciding, oh, this is it. You know, this now it actually has bottomed out. Because there's probably a number of instances along the way where one might have believed that. And, you know, probably, if anybody caught the recorded Zoom session with Jamie Dimon where he was lambasting those who wanted to continue to work from home, it's a good listen, by the way, if you haven't. Somebody secretly recorded it, and he does not view this stuff very favorably. But what's interesting about it is that, of course, one thing that could potentially reverse some of the consumer goods that have floundered since people started working from home, and that could be apparel companies, it could be cosmetics companies, all of those things, is that if people actually do start going back to the office, they're probably going to start buying clothes to show up at the office, and they might start wearing makeup again. So if that's the thesis, I would be okay with that. But I will say that I'd probably wait to see a definitive reversal, because in the grand scheme of things, this stock was over $350. It's $70 now, right? So it goes back 10%. I mean, if it's gonna go anywhere back to where it once was, that first 10% is going to be nothing. And it's not like it's hugely cheap here, right? If you start to see a quarterly earnings result that really turns things around, look at this. I mean, the full year for June, right? So that's going to be the end of their fiscal year. $1.41 a share on a trailing basis. It's not like that's really cheap. It's $71 a share. Even off of next year's anticipated earnings, which may or may not be optimistic, we don't know. But that's not hugely cheap, right? $71.40 at $234. I mean, it's trading 30 times 2026 numbers. And what do we got for a free cash flow yield? That's the other thing I'd be interested in. So 560, we'll just use round numbers, 560 over 25 billion. 2.2% free cash flow yield, but not growing. You know, maybe your wife knows something I don't. I'm not in love with it. Obviously a better bet than it was at 140, but why not wait for some kind of a definitive reversal. My 2 cents. Okay. PC, 1 of 2. What would be a good long-term bullish... Oops, I lost the line. Long-term bullish option strategy for IoT. Implied 30-day implied vol 73, 30-day historical vol 41, spread 41. Okay. Earnings on March 6th. Implied vol went down 65 today. Implied vol rank 5182. Okay, so first of all, you're
part 2.
Oh, and there's a part 2. Should I buy the long options first and wait until the day before earnings to sell the short? So legging into, the problem with legging into trades, that can work out really nicely. It can also work out very badly. For all of the reasons that you would expect, right? Imagine, for example, that I said, okay, I'm going to put on a risk reversal. I want to buy an upside call. And I'm going to leg into my trade. Well, the problem is that buy the upside call, sell the downside put. If the thing sort of lingers and you're waiting to leg into it, let's say you're waiting for the stock to drop so you can sell your put, that thing's decaying away each day. So the amount that, and so is your call. So the whole purpose of having that trade on is not really working out. Now maybe the stock gaps lower, you sell a juicy put, or maybe the stock rips and you could potentially sell an upside call, but then you didn't gain on the put. So I guess my point is that it is, again, this squeezing the balloon thing. You're trying to take advantage of one aspect, but there's no free lunch. So I'll say that. The thing I do like what you're thinking about, though, is we care about the 30-day vol, historical vol, relative to the implied, because that, in a way, is what you're paying for. But the thing is that because it captures earnings, that implied volatility is going to have some stuff baked in the cake that has nothing to do with historical, and that has everything to do with what is going to happen on that day. So we're going to take a look at that really quickly to see how the implied move looks. Well, I mean, let's go back in time a little bit more. Not the lowest that it's been, but it's closer to the low end. Most recent quarter was well inside the implied move. The previous one was outside, but only just. Looks like it's been a pretty good predictor, hasn't it, of the implied move. So it looks like the options have been fairly priced. If anything, a little underpriced. Because here it was just outside, here it was right on the boundary, outside, right on the boundary, outside, right on the boundary, right on the boundary, just outside. So if we assume that the options markets are pretty good at predicting, again, I'm really sorry, because it's got to be tough to listen to me. Yeah, I mean, I would probably expect that the move is going to be in line. It seems to be pretty reasonably predicted there. So let's just take a quick peek. And actually, you know what? Since we were talking about strangle swaps and how they generally have a bullish tilt to them, I'm going to use that as an example here. Maybe I will. Let's see. Oops, and I put in the wrong ticker, of course. Oh, you know what I need to also double check is when is their subsequent. So March 6th and then June 6th. Okay, makes sense. So we could go out here. And we're going to just get long, call it a put. I'm going to adjust these strikes in a second. And we'll just go ahead and sell. We'll just, for simplicity, we'll just use the March regulars in this example. And let's just say, again, for the sake of argument, that we're going to sell the 20 delta put, or something close to it. And we're going to sell the 20 delta call, or something close to it. You can't get that close to it. That's we've seen some decent sized moves. Where are we now? 60. Yeah, that's probably okay. And I'm going to match the strikes in this thing. And you end up with a strategy that looks a little bit like this. So this is mildly bullish. And yeah, so Steve Garcia, you pointed out that the strangle swap I showed on Bob, it had a bullish tilt. They typically do. Remember that Vega, among other things, is going to be a function of the strike. So all else equal, a higher strike is going to have a higher Vega. If you're at the money, 100 strike is going to have a higher Vega for the same vol, same time to expiration as a 50 strike or a 25, right? So they will tend to have a bullish tilt. But that's a strategy I think that would probably work out. Any thoughts on Intel? Yeah, so they were just selling their programmable chips business, right? Wasn't that announced yesterday, I think? Not a big fan of Intel. But, at least they are being run, I think, by engineers now. So that's a positive. I think they were having quite a rally. Yeah, we can see that here. And they've got a long way to go. I kind of like it as a speculative long because, like I said, their biggest problem was that they were being run by non-engineers for a while. We've seen this in a couple different businesses. They employ, company gets successful, they replace the engineers that built the company with bean counters, and things turn out badly. So there is a potential. There is some potential for the upside if they get their mojo back, and I'm kind of hopeful that they will. An iconic U.S. company. By the way, did you guys see this bit from Satya Nadella today? So he was sending out some stuff about quantum. So they're making some progress on that, which is, very exciting. But that can really turn things around a little bit. I mean, it's still a long ways off, but they were talking about getting to 1 million qubits. It was a tweet that he sent. I want to see if I can find it. I don't know that I follow him. Oh, here it is. So he says, a couple of reflections on the quantum computing breakthrough we just announced. Most of us grew up learning there are three main types of matter that matter. Solid, liquid, and gas. Today that changed. After nearly 20-year pursuit, we've created an entirely new state of matter, unlocked by a new class of materials, topoconductors, that enable a fundamental leap in computing. It powers Majorana 1, the first quantum processing unit built on the topological core, and we believe this breakthrough will allow us to create a truly meaningful quantum computer, not in decades, as some have predicted, but in years. The qubits created with topoconductors are faster, more reliable, and smaller. They are 1/100th of a millimeter, meaning we now have a clear path to a 1 million qubit processor. Imagine a chip that can fit in the palm of your hand, yet is capable of solving problems that even all the computers on Earth today combined could not. This thing, powerful than all computers currently in existence. That's what he's talking about. Sometimes researchers have to work on things for decades to make progress possible. It takes patience and persistence to have big impact on the world, and I'm glad we get the opportunity to do just that at Microsoft. And this is our focus. Now, in the midst of all of that, I heard a guest on Sean Ryan's podcast recently allude to the fact that he believes that near-peer adversaries may actually be ahead of us in quantum. And I've heard this before. So at the Crossroads trade station, I was a speaker, well, more of a panelist really, at the Crossroads Summit in Miami the week before Thanksgiving last year in 2024. And they had some investors and specialists in quantum who were talking about the very real possibility that China could be ahead of us. They had a couple signs or signals that this could be the case. One was that some quantum computing scientists in the United States were having more difficulty reaching some of those in China. The other is that they know that there's been a whole city built in China specifically for this purpose. Now, I don't know if that's who Sean Ryan's guest was referring to, yes or no. I'm very happy and hopeful that we are, somewhere close in terms of our progress in this area, because it's scary if, there's real asymmetry in that kind of technology, especially outside of our control, and especially if it's a near-peer adversary. But this is a potential wrinkle, a big one, I would say, for legacy chip companies like Intel. Now, I was told during that whole event that conventional chips have a significant role to play in quantum. But will they be Intel's? Or will they be AMD's? Or one of the lesser chips from NVIDIA? Don't know. Those are real risks. So, yeah. I mean, again, I'm not sure that's super, super helpful. Did I skip a question here? I thought I did, but I may not have. And I have chewed up well over an hour of your time, and I've made you suffer through my cold, which I am very apologetic about. I should have popped a couple Sudafed before all of this. But I hope you did find this helpful. I hope you guys like and subscribe. Come back on Friday because we're going to be joined by Mark again. We're going to get some of his background in some of these things, including his background working as an engineer in the defense business before he went to graduate school once again for finance. And he may have some insights for us on this and some other issues, including those related to inflation, which is a particular area of interest and expertise of his, and other things like that. So, once again, that'll be on Friday. It'll be 2 o'clock Eastern, by the way. Yeah, I should mention that because Mark, due to his teaching schedule, that's kind of like his office hours window available for us. So it'll be earlier than we usually do it, but you can always come back and watch the replay if you're unable to join us live at 2 on Friday. Hope to see you then, and thank you for suffering through this with me. Thanks for watching.